Valuation and Analysis, Bonds with Embedded Options. We'll start this reading by talking about different types of embedded options. The most important embedded options are embedded call options, embedded put options, and embedded conversion options. So in this context, we need to recognize that we have callable bonds, puttable bonds, and convertible bonds. We'll then look at how the arbitrage-free valuation framework is used to value callable and puttable bonds. We discussed this framework in the previous reading. Now the framework will be applied to actually value bonds with embedded options. Then we'll look at how option-adjusted spreads, so OAS, are used to value risky callable and puttable bonds. The next segment deals with the need to use effective duration and effective convexity to measure the effect of interest rate movements on the value of callable and puttable bonds. So effective duration and effective convexity are tools that make it relatively easy to measure the impact of changes in interest rates. So when there is a change in underlying rates, what is the impact on the value of bonds and the value of bond portfolios? We'll then look at the valuation of capped and floored floating rate bonds. You might recall from earlier readings that floating rate bonds or floaters have coupon payments that go up and down with a reference rate. But we can also have a capped floating rate bond where there is a certain cap in terms of coupon payments, even though interest rates might go above that cap. But once the cap is hit, that limits the coupon payment. Similarly, we can have floating rate bonds with a floor or a minimum coupon. And the question now is, how are these bonds valued? That's what we will discuss here. And the final segment of this reading is on the valuation of convertible bonds. Overview of embedded options. This is largely a recap of what you've seen before. The most common type of embedded option is a call option, and let's just recall what this means. Say we have a 10-year bond, and let's say that this bond is callable after 5 years. The call option gives the issuer the right but not the obligation to call the bond back before maturity. In my simple example, I'm saying that this bond is callable after 5 years. This means that for 5 years, the bondholders have protection. This is called the lockout period. It is also called the call protection period. Now, as with regular options that you have studied in derivatives, there can be different types of call options. We can have an American style call option, which can be callable any time after the lockout period is over. We can have European style options which are callable only on a particular day, and we can have Bermuda style options where there is a schedule or a set of dates on which the bond can be called. I also want to point out why these options are called embedded options. They are embedded because they are an intrinsic part of the bond. We cannot pull out the option and trade it or sell it separately. So the option only has meaning in the context of the underlying bond. Now, the underlying bond can also be thought of as a straight bond or an option-free bond. And as we'll see later, a bond with an embedded call option is really a combination of a straight bond or an option-free bond and the call option. Next, put option. With a put option, the bond holder has the right to put the bond or give the bond back to the issuer at a particular price, which is typically the par value before expiration. So if we have a puttable bond with a maturity of 10 years and this is puttable after 5 years, then this means that after 5 years the bondholder can give the bond back to the issuer and receive par value. Extension options are like put options in the sense that they give a benefit to the bondholder. With extension options, a bondholder has the right to keep holding the bond for a certain number of years at a particular coupon rate after the official expiration. So let's say we have a 10-year bond with an extension option of 3 years. This means that at the end of 10 years, the bondholder has the right to keep the bond for another 3 years and receive a certain coupon rate that obviously will be specified in the bond indenture. Conversion options typically give the bondholder the right to convert the bond into a certain number of shares, and this is something we'll be discussing in detail later. Note that put options, extension options, and conversion options all benefit the bondholder, whereas call options benefit the bond issuer. Conversion options are generally categorized as complex embedded options, but given that this material is relatively more testable compared to other complex embedded options, I have shown it separately. And in fact, there is a full section in this reading on convertible bonds. Coming now to other types of complex embedded options. There are two major examples given in this reading. One is bonds with an estate put. The idea here is fairly straightforward. Let's say that we have a bondholder who dies and the bond then goes to his heirs. With an estate put, the heirs have a right to put the bond or give the bond back to the issuer and get par value. Obviously, it only makes sense for the heirs to put the bond or return the bond if the bond is trading at a discount. If the bond is trading at a premium, then it makes sense to either keep the bond or sell it at market price. Sinking fund bonds require the issuer to set aside funds over time in order to retire the bond issue. This helps reduce credit risk. Sinking fund bonds might have other provisions such as acceleration provisions or delivery options. As you might imagine, valuing complex embedded options is extremely difficult, and this particular reading does not focus on embedded options. You will see that most of this reading will deal with call options, put options, and conversion options. Let us now do example 1. Investors in puttable bonds most likely seek to take advantage of, and I want you to try this first. Here, movements in the price of the issuer's common stock. This is not true. This applies with convertible bonds. So it's either A or B, and I'll tell you that the correct answer is A. The idea is straightforward. If you think about the price of a bond, when interest rates go up, the price of the bond comes down. So if interest rates do come up and let's say the price now is down, so the bond is trading at a discount, a put option will be extremely valuable because now the investor or the bondholder can give the bond back to the issuer at par value and benefit relative to the market price. The decision to exercise the option embedded in an extendable bond is made by whom? The answer, as we've discussed before, is the bondholder. Recall that with a callable bond, the option is with the issuer. With an extendable bond or a puttable bond, the option is with the bondholder. What about for a convertible bond? Here again, the option is with the bondholder. Valuation and analysis of callable and puttable bonds. What we'll do first is consider a straight bond and look at the impact on the straight bond of different kinds of embedded options. Then we'll do a quick recap of how to value a default-free, option-free bond. This is material that we've seen before. In section 3.3, we will learn how to value callable and puttable bonds in the absence of interest rate volatility. First, the basic relationship between the values of a callable or puttable bond, straight bond, and an embedded option. Consider a callable bond. The value of a callable bond is equal to the value of a straight bond minus the value of the issuer call option. The idea here is straightforward. Consider a 5-year default-free bond with no embedded options. So that is, let's say, a straight bond, and say the value of that straight bond is 100. Now, if we have another bond that is similar in all respects, except that it has an embedded call option, that embedded call option obviously is of value to the issuer. The bondholder does not like the fact that the bond can be called, because the bond will be called when interest rates go down, and that is the time when the bond price goes up. So clearly the bondholder does not like the call option. Therefore, the value of the callable bond, this is the amount that bondholders will be willing to pay, will be less than the value of a comparable straight bond. So let's say that the value of the callable bond is 98. This would imply that the value of the issuer call option is 2. So using simple algebra, we can just then say that the value of the issuer call option is the value of the straight bond minus the value of the callable bond. With puttable bonds, the opposite holds true. Bondholders or investors like the put option. So the value of a puttable bond will be more than a comparable straight bond, and that's why we have this value of a puttable bond equal to the value of a straight bond plus the value of the put option. And going with a similar example, say the value of a straight bond is 100 and we have a comparable puttable bond similar in all respects except that this bond has a put option. If the value of that put option is 1, then the value of the puttable bond will be 101. And again, using basic algebra, we can say that the value of the put option is equal to the value of the puttable bond minus the value of the straight bond. A quick refresher on how to value an option-free bond, and this uses the following interest rates. We are considering a 3-year 4.25% annual coupon bond, and remember this because this type of bond and the interest rates that are shown over here will be used throughout the reading. We are given the par rates. From the par rates, as you have studied before, we can calculate spot rates. From the spot rates, we can calculate the various forward rates. So how do we come up with the value of this bond? It is a straight bond and we are assuming no interest rate volatility. We simply discount each cash flow at the relevant spot rate and come up with this value. We can also use forward rates, and since we've done this before, I will not repeat. All I want you to remember is that we are working with a 3-year bond and the cash flow is 4.25, 4.25 and 104.25 as shown over here. Now we look at the valuation of default-free callable and puttable bonds in the absence of interest rate volatility. Again, the same bond, but let's say that it is now callable at par 1 year and 2 years from now at 0 volatility. So what's going on? What we do here is look at the cash flow and then we start at the end. Given here is this particular forward rate. If I were to draw the timeline, so 0, 1, 2, 3, the cash flow at the end of year 3 is 104.250. This rate, 4.564%, is the 1-year forward rate that is relevant for the 3rd year. So using the terminology that we've seen in earlier readings, this would be the forward rate that goes into effect over here, end of year 2, and it is a 1-year forward rate. So with that forward rate, we can discount 104.250 and come to this number, which is 99.7. Since this number is less than 100 and 100 is the value at which this bond can be called, it is callable at par. Since the market price based on this calculation or the expected price is less than par, the bond will not be called. What about the price of the bond or the expected price of the bond over here at the end of year 1? What we do is take 99.7, add the coupon. So we have this number which represents the value over here, end of year 2, and discount back at this forward rate. This forward rate is 3.518%. When we do that discounting, we get a number that is larger than 100, which means that the bond will be called, and it will be called at 100. So the value today then becomes the discounted value of 100 plus the coupon rate of 4.250, discounted at the spot rate today, which is 2.5%, and this gives us a value of 101.70. Now I want you to compare this with the number that we got on the previous slide. So this number 102.114 is the price or value of a straight bond, 102.114, and the value of the callable bond is obviously less than that. That is 101.707. If we find the difference of these two numbers, we will get the value of the call option. Next, we look at a bond that is puttable at par either 1 year or 2 years from now, and again we assume zero volatility. Remember, the bond will be put if the value falls below par, and using the same sorts of calculations, the cash flow at the end of year 3 is 104.250. To come up with the expected price at the end of year 2, we discount at this forward rate and we get a number less than 100. This means that the bond will be put at 100. Then one period before, we take 100 plus the coupon and discount at the relevant forward rate, and we get a number that is more than 100, so it will not be put. And then we bring that back, add the coupon and discount at the 1 year spot rate, and we get this number. Notice that this is larger than the number that we got when we valued a straight bond, and the difference between the two numbers now would represent the value of the put option. Example 2 compares the value of callable and puttable bonds. I want you to do this before looking at the solution. Notice that bond A is option free, so it's a straight bond. B has an embedded call option, and C has both a call option and a put option. We've not said this explicitly before, but it is indeed possible for a bond to have both these options. Now, the value of bond B relative to the straight bond is obviously going to be lower. Why? Because bond B has a call option. Bondholders do not like call options, and therefore they will pay less for B relative to an option-free bond. Next, we compare B and C. Notice that B and C are similar, except that C also has a put option. Now, since C has a put option which investors like, therefore investors will be willing to pay more for C. And finally, if we have an upward sloping yield curve, that means that interest rates are expected to be higher in the future. Higher interest rates means that bond prices are likely to come down. If bond prices come down, it is more likely that the put option will be exercised. Now, let's say on your exam you get a question which says that we have a downward sloping yield curve. In that case, obviously the call option is more likely to be exercised, because if interest rates do indeed come down in the future, the bond price will go up, and it will be sensible for the bond issuer to call the bond back at a price lower than the market price of a comparable straight bond. So far we have considered scenarios with zero interest rate volatility. Now we make our analysis more realistic by considering interest rate volatility and the impact of this volatility on callable and puttable bonds. This material has been covered in the previous reading, so this is a quick recap. The value of an embedded option, regardless of the type of option, increases with interest rate volatility. The greater the volatility, the more opportunities exist for the embedded option to be exercised. This connects with material that you have seen in derivatives at level 1. When the underlying becomes more volatile, the value of the option goes up. Whether it's a put or a call doesn't matter. In this case, the underlying is interest rates. So if interest rates become more volatile, then it is more likely that rates will be relatively high. Relatively high rates imply that it is more likely for the bond price to come down. So it is more likely that a put option will be exercised. So therefore, put options become more valuable. With volatile interest rates, it is also more likely that rates come down, which means that it is likely that bond prices go up. Therefore, it is more likely that call options will be exercised. So that's the reason why both call and put options become more valuable when volatility increases. And this graphic depicts what we have seen in the earlier slides. There is a current short-term rate today, and when we construct the tree, we make a certain volatility assumption. And you might recall that if we make a volatility assumption of 15%, we generate a certain tree. If we change the volatility assumption to say 20%, then the tree becomes wider. In other words, these nodes become more dispersed. What we are looking at here is the value of a 30-year 4.5% bond, which is callable at par in 10 years under different volatility scenarios, assuming a 4% flat yield curve. So our yield curve is flat, but we are assuming different volatility numbers. The different interest rate volatilities are given on the x-axis, and on the y-axis we have the value of the bond. This total bar represents the value of a straight bond or an option-free bond. Notice that as long as we have a flat yield curve, the value of the straight bond is not impacted by different interest rate volatility numbers. However, this white segment of the bar represents the value of the call option. So that means that the gray bar represents the value of the callable bond. Remember, the value of a callable bond is the value of the straight bond minus the value of the call option. And notice, as interest rate volatility increases, the value of the call option increases and the value of the callable bond goes down. Here we look at the impact of volatility on a puttable bond. Here the total bar represents the value of a puttable bond, and if this is the total value of the puttable bond, the gray or shaded part represents the value of a straight bond and the clear part represents the value of the put option. We notice that as interest rate volatility increases, the value of the straight bond or option-free bond does not change, but as interest rate volatility increases, the value of the put option increases, and since a puttable bond is equal to the straight bond plus the put option, the value of the puttable bond goes up. Now we look at the value of a callable bond under different flat yield curve levels, but keeping the volatility fixed at 15%. So what happens here? Let's say we start at a high interest rate of 5%. At a high interest rate, this represents the value of the straight bond. The clear part is the value of the call option, and then the shaded part is the value of a callable bond. As interest rates go down, the value of the straight bond goes up, and that is consistent with everything that we've studied. As interest rates go down, the price of the bond goes up. But notice, as interest rates go down, the value of the call option increases. So the value of the call option here at a 3% interest rate is much more than the value of a call option at a much higher rate of 5%. The reason is, at lower interest rates, the call option is more likely to be exercised, and that is why it has a higher value. Next, we look at the value of a call option embedded in a callable bond under different yield curve shapes, and we are keeping the volatility fixed at 15%. So one scenario is a flat yield curve, another scenario is an upward sloping yield curve, and then the third scenario is a downward sloping yield curve. Recall that a call option is more likely to be exercised when interest rates come down. And that is why, if we have a downward sloping yield curve where the expectation is that interest rates will come down, the value of the call option will be higher relative to a flat yield curve scenario. And if we continue with that logic, if we have an upward sloping yield curve, then obviously it is less likely that a call option will be exercised, and therefore the value of the call option is even lower. We are going to look at a similar picture for put options, but I want you to pause the video at this stage and very quickly sketch what you think a similar picture will look like if we are considering a puttable bond. Alright, we now talk about puttable bonds, and we fix the volatility at 15% and look at different interest rate scenarios. Here the shaded portion represents the value of a straight bond, and as we've discussed before, with interest rates going down, the value of the straight bond obviously goes up. However, if we consider the value of the put option, this is going to be high when interest rates are high, because the probability of the put option being useful or being exercised is more if we have high interest rates. As interest rates become lower and lower, the value of the put option becomes smaller because the put option is less likely to be exercised at low interest rates. Now here is the picture that I asked you to sketch earlier. The put option will be most valuable when we have an upward sloping yield curve scenario, because here expected interest rates are high in the future and the put option is more likely to be exercised at high interest rates. We'll now look at how to value default-free callable and puttable bonds in the presence of interest rate volatility. We follow a three-step process. Step 1 is to generate a tree of interest rates based on the given yield curve and interest rate volatility assumptions. Step 2 is the following. At each node, we should determine whether the embedded options will be exercised. In step 3, we apply the backward induction valuation methodology to calculate the bond's present value. This methodology involves starting at maturity and working back from right to left to find the bond's present value. Let's understand this through an example. Say we have a 3-year bond. This is the coupon rate. The bond is callable at par 1 year and 2 years from now. The volatility is 10%. We will use the same interest rate tree that we have seen earlier. So given the term structure, these are the forward rates, and we will now apply the backward induction methodology. At the end of year 3, these are the cash flow. So the cash flow is always the same. It is the par value of 100 plus the coupon. Now we need to come up with the value at this node. The relevant interest rate to use at this node is 5.5258%. So we take 104.250, discount back at this rate, and this is the value that we get. We follow the same process at the other nodes. So at this node, the relevant rate is 4.5% and the value is this. And then at the bottom node, the rate is 3.7%. We get a value of 100.5. This needs to be written down to 100 because the bond is callable at 100. We then go back further. With this node, the rate is 3.8695. That's coming from here. So we discount back 98.791 plus the coupon of 4.2. We also discount 99.738 plus 4.25 and find the average. And that gives us 99.658. For this node, we use 3.1681, that's this rate, and what we do is we find the present value of these two numbers, so 99.7 plus 4.2, find the present value of that, find the present value of 100 plus 4.25, and then take the average of those two present values. When we do that, we will get 100.9, but since this is callable at 100, we need to write down to 100. And then finally, we take 99.58 plus 4.2, discount back at 2.5%. We take 100 plus 4.25, discount back at 2.5%, take the average of those two numbers, and we should get the value of the bond, which is 101.540. Recall that when we came up with the price of a similar straight bond, so same duration, same coupon rate, same volatility, the value of a straight bond was 102.114. Here, as expected, for the callable bond, we are coming up with a lower number, and the difference between these two numbers is the value of the embedded call option, which is 0.407. Now I want you to work through example 3. And I'll just remind you about what this means. A Bermudan style option is one where the option can be exercised on one of several dates. And that's what's happening here. Since with this particular bond, the bond can be called either 1 year from now or 2 years from now, this is a Bermudan style. With a European style, the bond can be called only on one particular day. With an American style, the bond can be called any day after a certain date. So we are using the same interest rates as before. The volatility is 10%. Assume that nothing changes relative to the initial setting except that the volatility is now 15% instead of 10%. So we now have a higher volatility number. What will happen to the value of the callable bond? Remember, the value of a callable bond is equal to the value of a straight bond minus the value of a call option. At higher volatility, the value of the call option goes up, which means we are subtracting a bigger number, so the value of the callable bond will go down. Next, if the bond is now callable at 102 rather than 100, what's the new value of the callable bond? To answer this question, we need to go back and look at the interest rate tree. So if you notice here, the value of the bond is never more than 102. So it will never be called because this value is 100.526, which is less than 102. This would also be less than 102. Since the bond is never called, the value at time 0 should be the same as the value of a straight bond. So the best answer here then would be C, which is the value of the straight bond. Now we look at the valuation of a puttable bond. The idea is exactly the same, except if the value is less than 100, then we write up to 100 because the bond is puttable at 100. So we use the same backward induction process. Wherever we see something less than 100, we write up to 100 and come back and get this value of 102.522. So notice that this number 102.522 is larger than the value of the straight bond. So the value of the straight bond that we calculated earlier was this 102.114. The difference between these two represents the value of the put option. Now I want you to do this example. If the volatility goes up, then the value of the put option goes up, which means that the value of the puttable bond will go up. So the best answer is C. If the bond is puttable at 95, then looking at the backward induction tree again, we will notice that in our process, the value never comes below 95, which means that if this is the exercise value, 95, then the put option will never be exercised. If the put option will never be exercised, then the value of this puttable bond will essentially be the same as the value of a straight bond. So the correct answer here is B. This was the value of the straight bond. Now I want you to do example 5. The questions are on the next slide, but I'll also tell you here exactly what you need to find out. After reading this information, you need to come up with the price of bond X. For bond Y, you need to come up with the coupon rate. And the possible coupon rate options are as follows. One possibility is 4.2%, then 5%, and 6%. So you need to figure out which of these is the correct coupon rate for Y given the information on the slide. And then with bond Z, which is a puttable bond, you need to come up with the price. So with bond X, the correct answer is 99.95. So that's here. And this is what you do. Recognize that at the end of year 3, the cash flow is 105.20 no matter what happens. And we need to work backwards now. So this particular node here, the interest rate is 7.48%. We discount 105.2 back at this rate and we get this number, and 5.2 represents the annual coupon. At the bottom node, we have the low interest rate of 4.1%, and when we discount back, we get 101.05. This is higher than 100. The bond is callable at 100, so we reduce the value to 100. We then have 100 plus 5.2, which is what needs to be discounted back. So in this particular node, what we do is the following. So 105.2 is discounted back at this rate. Then from this node, 99.67 plus 5.2 is discounted back. And when we take the average of these two numbers which are discounted back, we get 100.7, which is higher than 100. That needs to be written down to 100. So we are using the same backward induction process that we've talked about multiple times. The only difference is that whenever the number is higher than the par value, we need to write down to par value for a callable bond which is callable at par. If we work all the way back, we get this answer. Here we need to find the coupon rate for bond Y. The long-winded method is to plug in each of these rates and use the backward induction process and see which rate gives us the price of 101.3. This price is given in the question. But you need to be smarter than that, because using backward induction for all three rates will take too much time. The question gives us this information. We are told that the 3-year par rate is 5%. So this means that a government bond, which is a straight bond with a coupon rate of 5%, has a price of 100. So If a call option were added to this, then what happens to the price? Given a 5% rate, a callable bond is going to have a price that is less than 100 because the call option is not seen favorably by investors, so the price actually will be less than 100. This particular bond where the price is given has a price higher than 100. That can only happen if the coupon rate is more than 5%, and the only option then becomes C. Next, we need to find the price of bond Z. Here we again use backward induction. I will have you do that work now. Remember, the process is the same as what we do for the callable bond. The only difference is that if at any node the price is below 100, then you need to write up the price to 100. And the answer that you should get is 100.34. What happens to the price of bond X if the interest rate volatility comes down? Now you need to remember, what was bond X? Is it callable or puttable? Bond X, if you recall, is a callable bond. So the price of a callable bond is equal to straight bond minus the call option. At a lower interest rate, the value of the call option becomes less, so we are subtracting a smaller number, so the value of the callable bond becomes higher. Correct answer is C. What about bond Z? Bond Z is puttable, so the price of a puttable bond is equal to straight bond plus the put option. If we have a higher interest rate volatility, put option value goes up, which means that the puttable bond becomes more valuable. So here again the answer is C. So far we've talked about risk-free callable and puttable bonds. Now we move to the valuation of risky callable and puttable bonds. Broadly speaking, there are two approaches for valuing risky bonds. And here, when we say risky, we are referring to default risk. So one approach is to value bonds by making the default probabilities explicit. This topic is covered in another reading. Here we focus on the second approach, which is to value bonds by increasing the discount rates above the default free rates to reflect default risk. And this is the method that is used much more often in the industry. Elaborating on this second method now, we've talked earlier about the yield curve based on government bonds, or based in the US context, it would be the yield curve based on treasuries. Now that's the yield curve assuming no default risk. And based on the yields, we talked about coming up with the spot rates and the forward rates. So everything that we've talked about so far, the forward rates, for example, are for government bonds where there is no default risk. What we now have to do for risky bonds is to raise the 1-year forward rates derived from the default free benchmark yield curve by a fixed spread. This fixed spread is estimated from the market prices of suitable bonds of similar credit quality. If we assume that interest rates are static, then the spread is called the zero volatility spread, or Z spread. The Z spread is appropriate to value bonds with no embedded options. If you recall, when we have a straight bond, then the value of the straight bond is not impacted by our volatility assumption. Since the value is not impacted by volatility, it is appropriate to use the Z spread for a bond that has no embedded options. However, if we do have risky bonds with embedded options, then we should use the option adjusted spread, or the OAS. The OAS is the constant spread that, when added to all the 1 period forward rates on the interest rate tree, makes the arbitrage free value of the bond equal to its market price. Now we are going to look at exactly what this means, but first we will just refresh our memory about the z-spread. And this is something that you have also seen at level 1. The idea is this. Say you are given a particular term structure, and based on this term structure, you can come up with the 1-year forward rates. If we know the forward rates, then how do we come up with the value of a risk-free bond? We simply take all the cash flows. So this is the first coupon, the second coupon, and then the third coupon plus the par value. And then we can discount. So the first cash flow is discounted at the 1-year spot rate. The second cash flow can be discounted at the 2-year spot rate, or we can simply multiply these two numbers, the current 1-year spot rate and then the 1-year forward rate after 1 year, and then the third cash flow is discounted like this, and we get 102.114. Now let's say that we have a 4.25% bond which is risky. So unlike the earlier bond, we now have default risk, and we are told that the z-spread is 100 basis points. So what does that mean? Now notice the method that we used up here. We discounted 4.25 at 2.5%. Here we need to add the z-spread to each of these numbers. So when we add 100 basis points here, we will get 3.5%. So wherever we had 2.5%, we now use 3.5%. Here we used 3.5%. This would become 4.5%. So notice across the board we are adding 100 basis points, and by adding 100 basis points, the price that we get is equal to the market price, and that's what we mean when we say arbitrage free value. So the z-spread is the single spread added uniformly to the 1-period forward rates to produce a value or a price for a bond, and this is the market price. And as you saw, we have assumed a set of forward rates, and the volatility here is 0. But in the real world there is volatility, and that volatility is important when we are valuing bonds with embedded options. The option adjusted spread is the single spread added uniformly to the 1-period forward rates on the tree. This is the interest rate tree that we've talked about earlier, to produce a value or price for a bond. These solid lines and then these particular nodes depict the interest rate tree based on risk-free bonds. So let's say that these are based on US government securities. Now we have a risky bond, and let's say that the price of a risky bond is $99 per $100 par value. So we come up with the interest rate tree based on government securities, and then we need to figure out what's that uniform spread that needs to be added to each of these rates such that the present value of future cash flows is equal to 99. That equal spread is the option adjusted spread. Now how can this be used? Let's say that you have two bonds, bond 1 and bond 2. They have similar credit characteristics in the sense that you believe that the credit risk is really the same for both. But when you calculate the OAS for bond 1, that option adjusted spread is less than the option adjusted spread for bond 2. This means that bond 1 is overpriced, or it is rich. Let me make this a little more tangible for you. Say that the option adjusted spread for bond 1 is 100 basis points and the option adjusted spread for bond 2 is 120 basis points. And you believe that both these bonds have the same credit risk. Now, when we value the bonds, if we are using an OAS of 100 basis points over the treasury rates, then the price of the bond obviously is being discounted at a relatively low rate, so this price is going to be high. whereas the price for bond 2 is going to be relatively low. If both these bonds have the same risk and bond 1 has a higher price, then it is overpriced or it is rich. On the other hand, if the OAS of bond 1 is more than the OAS of bond 2, then bond 1 is underpriced or cheap. Next, we look at the effect of interest rate volatility on the OAS for a callable bond. As shown in this picture, if interest rate volatility increases, the option adjusted spread comes down. In other words, when volatility increases, the interest rate tree becomes more spread out or more dispersed, and the OAS comes down. If the interest rate volatility is 0, then the OAS is the same as the Z spread. Now I want you to work through example 6. Carefully read this information, and you need to have this in front of you as you solve the questions on the next slide. So here is the first question. To update his valuation of the French corporate bond, what should Jordan do? Now, he had initially used the government rates, and he needs to add this 200 basis points to the rates in the binomial interest rate tree. So that's the correct answer. This is simply the definition of OAS. It's that fixed amount that needs to be added to the government rates or the benchmark rates in order to come up with the market price. Next, we need to calculate the value of the callable bond. Now, this is the backward induction process. It's similar to what we've done before, but the difference is that we now need to add 200 basis points to all the government rates given. So I'll set this up for you, and then you need to actually do the calculation. What I'm doing here is showing you the rates that you need to use. The cash flow at the end of year 3 is going to be 107, which is 100 par plus 7. Now, according to the government forward curve, the rate is 7.75, but to that we need to add 200 basis points. So the discount rate here for year 2, this is year 2 to year 3, the 107 will be discounted at 9.75 for this node, at 7.74 for this node, and 7.74 is 200 basis points bigger than 5.74%. So all these rates represent a number which is 200 basis points higher than the government rates. And based on that, we use the regular backward induction process. And as we saw before, since this is a callable bond, if we get a situation where the price is above 100, which happens in this node and this node, then we need to write down the value to 100 and then keep working backwards. The answer that we should get here using this method is B. If we initially had a 15% volatility, but then the volatility is increased to 20%, then what happens to the OAS? Here I want you to recall the picture that I showed you where we increased volatility and that caused the OAS to come down. So remember this relationship: as volatility goes up, OAS comes down. So higher volatility means that the OAS is going to be lower. The basic measure of interest rate risk is duration. The duration of a bond measures the sensitivity of the bond's full price to changes in interest rates. Broadly speaking, there are two categories of duration measures. We have yield duration measures and curve duration measures. Yield duration measures look at the sensitivity of a bond's price to changes in the yield of that bond. This measure works well for bonds where cash flows do not depend on interest rates. So yield duration measures work for straight bonds. They do not work for bonds with embedded options. For bonds with embedded options, it makes sense to use curve duration measures. The most popular curve duration measure is effective duration, which we will discuss on the next slide. Broadly speaking, these measures look at the sensitivity of bond prices to changes in benchmark interest rates. After discussing effective duration, we will then talk about effective convexity. Here is the measure that we will focus on, effective duration. This indicates the sensitivity of the bond's price to 100 basis points parallel shift of the benchmark yield curve. In particular, the government par curve. So that typically is our benchmark curve, assuming no change in the bond's credit spread. So note that effective duration works for all sorts of bonds. It works for government bonds, it works for corporate bonds, it works for bonds with embedded options. So that is why typically practitioners use effective duration for all types of bonds. The formula for effective duration is shown right here, and let's understand how the process of calculating effective duration works. Let's say we are given a particular price of a bond at a given interest rate. So say that price is PV0. At that price, we calculate the option adjusted spread to the benchmark yield curve, and obviously we need to assume a certain level of volatility. And earlier we have talked about how to calculate this option adjusted spread. Let's say that this option adjusted spread is 20 basis points. Next, we shift the benchmark yield curve down, generate a new interest rate tree, and then revalue the bond using the option adjusted spread calculated in step 1. And to some extent we've seen this before, so we know how to come up with the tree, and we come up with the tree assuming certain rates. Then we generate a new tree which is based on lower rates. Say we shift everything down by 100 basis points, and then we value the bond by also incorporating the option adjusted spread. The new value that we get is PV minus. So PV minus is plugged over here. We would expect PV minus to be higher than PV naught because at a lower rate the price of a bond will be higher. So we know PV minus and PV naught was the original price of the bond. Then we shift the benchmark yield curve up by the same magnitude as in step 2, and we generate a new interest rate tree. Then we revalue the bond using the OAS of 20 basis points in my example, and we get the value of PV plus. And finally, we use this formula to calculate the effective duration. The only item we've not explicitly discussed is this delta curve. The delta curve is the shock that I'm talking about. So in my example, if we generate this new interest rate tree by bringing the benchmark yield curve down, if we bring the yield curve down by 100 basis points, that is the curve. 100 basis points means 1%, which means 0.01 in decimal. So if we bring the yield curve down by 100 basis points, what we plug in here is 0.01. On this slide, we will compare the effective duration of different bonds. The first image here compares a straight bond, which is shown in blue, with a callable bond, which is shown in red. The x-axis represents interest rates and the y-axis represents price. The blue curve, which is the option-free bond or straight bond, is fairly straightforward. As interest rates go down, the value of the straight bond goes up, and we can think of effective duration as the slope of this curve at any point in time. At very high interest rates, the slope is low, which means that the effective duration is low. At relatively low interest rates, the slope is higher. So we can say that for an option-free bond, the effective duration is higher at lower rates. Now let's look at what happens to a callable bond. Let's say that this curve in red represents the price of a callable bond at different interest rates. Notice that at high interest rates, there is hardly any difference between the straight bond and the callable bond. The reason is that at high rates, it is extremely unlikely that the bond will be called. We can say that the call option is out of the money, so it has little or no value, and therefore the callable bond and the straight bond have the same price. At low rates, the call option has value, and that is because the probability of the callable bond being called is relatively high. The other way of looking at it is, if a bond is callable at par and say par value is 100, then the value or the price of the callable bond cannot exceed 100. Based on what we've talked about before, where we said that the value of a callable bond is equal to the value of a straight bond minus the value of the call option, we can actually see that in this picture. Let's say at this interest rate, the value of the straight bond is 101 and the value of the callable bond is, let's say, 99.9. Then the difference between those two numbers is the value of the call option. In terms of effective duration, notice that the slope of the curve for the callable bond is much lower than the slope for the option-free bond. So at low rates, the effective duration of a callable bond is lower than the effective duration of a straight bond. And we can make this broader remark that the effective duration of a callable bond can never exceed that of a straight bond. In image 2, we look at the comparison of a puttable bond, which is in red, compared to a straight bond, which is in blue. Now notice at relatively low interest rates, the value of the puttable bond and the straight bond are pretty close to each other. And that is because at low rates, the put option is out of the money. It is highly unlikely that the put option will be exercised. So that's why the two lines, the blue and the red, are more or less similar. At higher interest rates, the put option becomes valuable. So clearly the puttable bond is worth more than the straight bond. This is the value of the put option. In terms of duration, notice that the slope of the puttable bond curve is lower than the slope of the straight bond. So we can make this statement: the effective duration of a puttable bond cannot exceed that of the straight bond. Now let's look at an image from the curriculum. These two pictures that I just showed you are not from the curriculum, but I think they explain the point quite well. This is what the curriculum says. A particular sort of bond is being considered, and the details of the bond don't really matter that much. What is being shown is the effective duration on the y-axis and different yields or yield curve shifts on the x-axis. And what this is saying is that if this is the effective duration across different yields, as long as the yields are going up and down by 100. So if we look at, say, this curve over here, and we change yields up and down by 100 basis points, notice that the slope doesn't change too much. Just we can marginally say that as interest rates become lower, the duration or the curve becomes slightly more steep. So that's what's happening here. As the rates go down, the effective duration of the option-free bond becomes a little bit higher. But what about the callable bond? Notice that as interest rates keep becoming lower and lower, the slope of the callable bond starts approaching zero. This starts becoming flat, and that is what's depicted over here. As interest rates become lower, the duration of the callable bond becomes less and less. At high interest rates, so that's this area over here, the effective duration of the callable bond is roughly the same as the effective duration of the straight bond. With the puttable bond, the opposite is happening. At relatively low rates, the effective duration of the puttable bond is the same as the straight bond, but at relatively high rates, the effective duration of the puttable bond is less than the effective duration of the straight bond, and that's shown over here. Here is another exhibit from the curriculum. I think this in general is useful. We look at the effective duration of different types of bonds. If we consider cash, there the effective duration is 0. For zero coupon bonds, the effective duration is equal to maturity. So a 3-year zero coupon bond will have an approximate effective duration of 3. A fixed rate bond will have a duration that is less than maturity. A callable bond will have an effective duration that is less than or equal to a comparable straight bond. We just saw that. Similarly, with a puttable bond, the effective duration will be less than or equal to the duration of a similar straight bond. And for a floater, the effective duration is approximately equal to the time in years till the next reset date. Now we will talk about the concept of one-sided duration. When we are considering callable and puttable bonds, this concept is important. So let's go back to the picture for a callable bond. If this is price and these are different interest rates, what we said for a callable bond is that the picture looks something like this. So let's say that we are at this particular interest rate. Now notice that relative to this point, the slope on the right is very different from the slope on the left. So it might be useful to come up with the one-sided duration for the right, where interest rates are shocked upwards, and the one-sided duration on the left, where interest rates are shocked downwards. When we say shock interest rates, we mean change the interest rates. For this type of bond, some numbers given in the curriculum which should not surprise us. If we have an increase in interest rate of 30 basis points, then the one-sided up duration is 1.94 and the one-sided down duration is 0.84. The overall effective duration is 1.39. So this is calculated based on both PV minus and PV plus relative to this point. So we expect a number in between these two. When interest rates go up, we have a high number. So that is clearly visible here. Notice relative to this point, if interest rates increase, the sensitivity or the slope is more. If interest rates decrease, then the sensitivity of the price to changes in interest rate is less. The slope in absolute terms is less when we move left. And that is shown by this particular number. Here we do a similar analysis for a puttable bond, and I have drawn this line to represent the price of a puttable bond at different interest rates, and the solid line represents a straight bond. Now, let's say we are at this point. The effective duration is 3. The one-sided up duration is 1.49. So up duration would mean interest rates are raised, and we are looking at this slope. The one-sided down duration means that we are looking over here to the left of that point, and clearly you can see that the sensitivity of price to interest rates is more, so we see a higher number. On this slide, we talk about key rate durations. Key rate durations reflect the sensitivity of the bond's price to changes in specific maturities on the benchmark yield curve. Let's consider this particular callable bond, and let's take a 2% coupon rate. The price of the bond is well below par, and I'm going to explain what this number means. we are saying that the 30-year key rate duration is 22.07. What that means is if only the 30-year rate changes by 1% and all other rates remain the same, then the value or price of this 30-year bond with a 2% coupon will change by approximately 22%. Now, I'm also going to discuss some numbers over here. Notice that for this particular bond, which is well below par, the duration is quite high. This is what you would expect for a straight bond. With a straight bond, which obviously cannot be called, if the 30-year rate changes, then the price of that bond is expected to change quite a lot, especially if it is almost a zero coupon bond. So this is just paying a 2% coupon. Now, what if we have a 10% coupon and the price is almost 150? Why is the 30-year key rate duration so low? The answer is that this bond is well above par, and it is extremely likely that the bond will be called well before maturity. Therefore, the impact of a change in the 30-year rate is very low. Here we are looking at puttable bonds, and notice that for a 2% coupon puttable bond with a price that is well below par, the 30-year duration is very low. And this again is because this bond is very likely to be put well before maturity. Therefore, a change in the 30-year rate does not have much of an impact on the price. On the other hand, this bond, which is trading well above par, is not likely to be put. So the put option is not going to be exercised. Therefore, this bond will behave a lot like a straight bond. So that's why the effective duration is quite high. Effective convexity. What is shown here is a formula for calculating effective convexity, and then we have some information based on which we actually calculate the effective convexity of a bond. But before we do this, I want to explain what convexity means. Let's say that we have interest rates on the x-axis and price on the y-axis, and we are considering this red line. Notice that there is no curvature associated with the red line. We can then say that the convexity here is 0. So you can think of convexity as a measure of curvature. With the straight line, no curvature, therefore convexity is 0. The blue curve is convex. This will have a positive convexity. The greater this curvature, the more the convexity. Here, the convexity or curvature is negative. Sometimes we refer to this as concave. All these curves are with respect to the origin. So imagine that you are at the origin and looking at the curves. The blue curve will clearly be convex. The green curve is concave, but rather than saying concave, we typically say negative convexity. And then over here, the green curve and the blue curve are both convex or positive convexity. Now, how do we calculate the level of curvature? That's given by this formula. If we have the information shown here, we simply plug into this formula more or less the same way that we did with effective duration. We start out with a given value of PV naught. We have a certain option adjusted spread given the level of volatility. In this case, PV naught is this number. We shift the benchmark yield curve by a certain amount. That's the delta curve. If we shift by 30 basis points down and then up, then delta curve is 30 basis points or 0.3%. 0.3% in decimal is 0.003. We square that, and then PV minus is the price of the bond when interest rates go down. So notice when interest rates go down, the price is a little bit higher compared to when interest rates are increased. In a sense, what we are looking at here is numbers for a callable bond, and this green curve represents a callable bond. So we can calculate PV minus PV plus minus 2 times PV naught, which is the same number, and we come up with a convexity number that is negative. This is clearly the convexity of a callable bond. So notice that with callable bonds, as depicted by the green curve, there is a negative convexity at low interest rates. At high interest rates, the convexity becomes similar to straight bonds. With puttable bonds, the curve will look something like this. So we've seen this before. Here the convexity is always positive, as with a straight bond. In fact, at low rates over here, the convexity of the straight bond and the puttable bond will be almost exactly the same. At higher rates, the curvature or convexity of the puttable bond will be less than the curvature or convexity of the straight bond. Now let's work through example 7. I want you to read this information and have it handy as we do the questions on the next couple of slides. You need to find the effective duration of bond X. Here we simply plug numbers into the effective duration formula and we should get 2.21. Next, you need to find the effective duration of bond Y, and here again, if you simply plug the numbers into the formula, you should get 1.58. The next question is about what happens to the effective duration of the bonds if interest rates rise. To answer this question, I suggest that you quickly sketch out the bonds. So here the red represents a straight bond, the green represents a callable bond, and the blue represents a puttable bond. When interest rates rise, what happens to the callable bond? So if you look at this green bond, as rates rise, the slope actually seems to be increasing a little. So remember, the slope here represents the effective duration. So the effective duration is increasing, not shortening. So bond X shortens. This is not true. Bond Y, remember, is puttable. So X is callable, Y is puttable. As interest rates rise, what happens to the slope of this blue puttable bond? Notice the slope becomes less, which means that the duration is becoming shorter. So this appears to be correct. C, the underlying option-free straight bond corresponding to bond X lengthens. So they are talking here about the red bond, which is the straight bond. As interest rates rise, the effective duration actually is becoming less. Notice that the slope becomes less and less. It actually doesn't change that much over here, but if anything, it is becoming a little less. So clearly this is also not the correct answer. The best answer is B. Now try this. Here again, I suggest you sketch it out. So the solid line represents a straight bond. The dashed line here represents a puttable bond, which is what we are talking about. Say we are at this point. What does one-sided duration tell us? The bond is more sensitive to a decrease in interest rates. So from here, if interest rates go down, notice the slope is more relative to a situation where interest rates increase. So this indeed is the correct answer. Now try this. So bond X is a 3-year bond which is callable after 1 year. Say we are here at time 0, bond is callable after 1 year, and it's a 3.75% coupon bond. The price of this bond is affected by what? Intuitively, we can say that this bond will be impacted by multiple interest rates. So to say that it would only be impacted by a shift in the 1-year par rate and all other rates don't matter, that clearly doesn't seem right. Similarly, saying that only the 3-year rate matters and other rates don't matter doesn't seem right either. So intuitively, C appears to be the best answer. But let's get a little deeper. If you think about this callable bond, the price of the bond once it's callable is clearly impacted by this forward rate, and that forward rate is impacted by the 1-year spot rate, which is the 1-year rate, and the 3-year rate. So obviously these two rates will have an impact on whether or not the bond will be called, and that has an impact on the price of the bond. So again, the best answer is C. Now try this. Here again, I suggest you create the sketch. This dashed line represents a straight bond. The solid curve represents a callable bond, and X is callable. The effective convexity cannot be negative. That's not true. Obviously, at low interest rates, we have negative convexity, so that's not true. The effective convexity of bond X turns negative when the embedded option is near the money. This is true because over here, the embedded call option starts getting near the money, and as we move left, i.e. lower interest rates, and the option is nearly in the money, then we have negative convexity. As we move from right to left and interest rates become lower, then we start seeing negative convexity. Which of the following statements is most accurate? Bond Y exhibits negative convexity. Bond Y, remember, is puttable, which is depicted here by this blue curve. Notice that a puttable bond will never have negative convexity. So that's not true. For a given decline in interest rate, bond X has less upside potential than bond Y. And this clearly is true. The puttable bond at low interest rates has the same curve as a straight bond. And notice, as interest rates decline, the upside potential for both the straight bond and the puttable bond is much more than the upside potential of this green callable bond. So this is correct. Let's also do C. The underlying option-free bond or straight bond corresponding to Y exhibits negative convexity. That's not true. Straight bonds do not exhibit negative convexity. So the best answer is B. Valuation and analysis of capped and floored floating rate bonds. First, let's quickly recap the concept of a capped floater and a floored floater. A floating rate security is one where the coupon paid at the end of every period is based on a floating rate at the start of the period. If the floating rate is LIBOR and the LIBOR rate here is 6%, then the payment at the end of the period will be based on 6%. If over here the rate is 5%, then the payment here will be based on 5% and so on. Now, what if interest rates start rising and here the interest rate is suddenly 9%? The problem for the bond issuer is that the payments now will be very high. A cap protects the issuer by setting effectively a limit or a cap on the coupon payments. So if the cap is 7%, that means that over here the payment that will be made will be 7% of the notional principal and not the market rate of 9%. For the bondholder, this is not good because his receipt will be less than the market rate. A floored floater is the opposite. This sets a lower limit on the payments that need to be made, and this is beneficial to the bondholder. So if we have a floor set at 3% and interest rates go down to 2%, then the bond issuer still needs to make a payment of 3%. Now let's look at the valuation of a capped floater. First, the value of a capped floater is equal to the value of an otherwise similar straight bond minus the value of the embedded cap. This minus should remind you of an embedded call option. There also we subtracted because the embedded call option is not good for the bondholder. Now I want you to read this from the curriculum. The only point that I will emphasize here is something you might not have seen before: set in arrears. This simply means that the rate that is paid at the end of any period is set at the start of the period. We are also told that the credit quality matches the LIBOR curve, and the floating rate in this example is LIBOR. The cap is 4.5%. We are using the same rates that we have seen before, and based on these rates, the forward rate at the end of year 2 in this node is 5.5%, which means that if there were no cap, then the coupon rate would be 5.5% over here. But since there is a cap of 4.5%, we write down the coupon. So there is the $100 par, and the coupon will be 4.5 based on the cap. So we write down and get 104.5. And then the same happens all the way through. Notice wherever the coupon payment is more than 4.5, we write down and get 4.5. If the coupon payment is less than 4.5%, then obviously we simply go with the number. Other than that, we follow the regular backward induction process and we come up with the value. So this is quite similar to what we have done with callable bonds. The value that we get is 99.761. If this bond did not have a cap, then the value at time 0 would be 100. This is because for a floating rate security where the credit risk is not changing, the present value at reset dates is equal to par value. So that number would be 100, and as expected, the value of this bond given the cap is less than 100. The difference between these two numbers, 100 minus 99.761, represents the value of the cap. So in this example, the value of the embedded cap is 0.239. Value of the cap floater 99.76. Value of straight bond is 100. This is a straight bond which has floating rate payments. Now we come to the valuation of a floored floater, and as you might expect, the value of a floater is the value of a straight bond. So this is a floating rate bond without any floor plus the value of the floor. This is a plus because the floor benefits the bondholder. Now in this case, the floor is set at 3.5%. If the payment at any point is less than 3.5%, then we write up. In year 3, the payments are always more than 3.5%. So we have the 100 par, and in all these cases, the interest rate is more than 3.5%. So we do not write down in any of these scenarios. But in this node, notice that the interest rate being used that is coming from here is 3.161. So here we need to set up a coupon rate of 3.5. And similarly over here, we need to write up to 3.5. Notice that this node really has two parts. The top part goes back to this node and the bottom part goes to this node. The value for both the top and bottom would be 100, but the coupon payments are different. When we discount back to the top left, then the coupon rate is 3.86, which is coming based on this rate, and that number is higher than 3.5%. So the value that is discounted back here is 100 plus 3.8695, and that is discounted at this rate, so the value over here is 100. But here the numbers are slightly different. Notice that this coupon rate 3.16 is coming based on this rate 3.168. The number is less than 3.5%, so we write up the coupon payment to 3.5%. That's the flow. And then coming from here to here, we have 100 plus 3.5 being discounted at 3.1681, and since this discount rate is lower than 3.5%, we get a value that is more than 100. Then we take 100 from here plus the coupon of 3.5, and notice here we take a coupon of 3.5 because the rate at the start of the period is 2.5%, so we write up. And in this node also we use 3.5, and then when we discount back both these numbers and take an average, we get 101.1. So the value of the floater is more than 100. Had this bond not had the embedded flow, the value would be 100, but because of that embedded flow, there is additional value of 1.133, making the total value equal to 101.133. Now I want you to work through example 8, where you have to value a bond with a cap and then value a bond with a flow. For your convenience, I'm giving you the forward rates. So this is the time zero rate, the rate at the end of year one, or the possible rates at the end of year one, and the possible rates at the end of year two. All these are forward rates that you should be familiar with, and these rates apply to both the questions. The first one is actually a trick question. The cap is 5.6. That cap is higher than any of these interest rates, and therefore the cap will never be used, and the bond price then will be 100. And this again goes back to the basic point that as long as the credit risk does not change, the value of a floating rate bond at reset date is going to be par value. What about the second question? So here we have a flow at 3%, and you can see that this flow will actually be used because this rate is less than 3%, and we use our backward induction process. Wherever the coupon is less than 3.5%, we write up. We know that the value of this bond is going to be more than par value, so A can be ruled out. The answer is either B or C, and if you work back using the method that we have just talked about, the answer that you should get is B. Now try this question. When solving this problem, the first thing that you should do is increase all the interest rates by the credit spread of 320 basis points. So when we take all the given Euribor rates and increase by 320 basis points, we get these numbers. Next, what we should do is recognize the cash flows based on these numbers and the cap. So notice the cap will kick in this node and this node. So since the cap is 5.5% and the rate here is higher than the cap, so in these two nodes the cash flow is going to be 105.5 based on the cap of 5%. And then in these nodes, based on the rates that are lower than 5.5%, we simply will have a coupon payment of 5.49 associated with this rate and 5.19 associated with this rate. And then as we work backwards, since the rates are always lower than the cap, we are not going to have the rate or the coupon ever being capped, at least given these rates. Then we use a backward induction process, and the answer that we should come up with is 99.916. So that is the correct answer. Valuation and analysis of convertible bonds. A convertible bond is a hybrid security. It has characteristics of bonds as well as equity. In simple terms, a convertible bond gives the holder the right to convert the bond into equity. Here are the subsections that we'll go over. We'll discuss the defining features of a convertible bond. Then we'll do a basic analysis of convertible bonds. Let's start with the defining features of a convertible bond, and we'll do this through an example. So here is a particular convertible bond. The company is Waste Management, and it has issued convertible bonds worth this much, 4.5% coupon rate. These are callable convertible bonds. So they have an embedded conversion option that benefits the bondholders and a callable option or an embedded call option that benefits the issuer. Now let's go through the various features of this bond. The interest is 4.5%. That's coming straight from here. The issue price is 100% of par denominated into bonds of 100,000. So the par value of each bond is 100,000 and the price is quoted in terms of a percent. The conversion period is shown right here. This is the period during which the bondholder can convert the bond into equity. The initial conversion price is £6 per share. This needs to be read along with the conversion ratio. The conversion ratio says that each bond is convertible into this many ordinary shares. Now, if the bondholder chooses to convert, then the money that will be paid will be the number of shares multiplied by the conversion price of 6. Another subtle point is that we are given an initial conversion price. This is the conversion price at issue date. Now after this, if there are certain corporate events like stock splits and so on, then the conversion price can change. I have highlighted these three terms because in the context of convertible bonds, you must understand these terms: the conversion period, the conversion price, and the conversion ratio. There are other terms that are also given here. I'll explain these at a high level. A threshold dividend of 30 pence per share means that if the dividend paid by the underlying stock exceeds this amount, then the conversion price will come down. Now, exactly how that works is outside the scope of this discussion. Change of control conversion price. This says that if the company is acquired by somebody else, then perhaps the bondholders will not be as comfortable holding the bonds of the other company. Then the way the bondholders benefit is, rather than having a conversion price of 6 per share, the conversion price will come down to 4 per share. And then the last bullet has to do with the embedded call option. We are also given market information for this bond. So on 4th April, we are given the price of the convertible bond. We are given the share price on issue date. We are given the share price on 4th April. We are given the dividend per share. Notice that this dividend is much lower than the threshold dividend. And we are also given the share price volatility. This gives us a sense for the riskiness of the underlying stock. Now let's do an analysis of the convertible bond. So what is the conversion value? This is the underlying share price times the conversion ratio. For the bond that we are talking about, on issue date, the share price was 4.58. So the conversion value is the price of 4.58 times the conversion ratio. This is the number of shares that a bondholder would get, and that gives us this number. On 4th April, the share price has gone up, so the conversion value goes up. The conversion value represents the value if the bondholder converts into equity. And notice that on 4th April, the conversion value is still well below the market price of the convertible bond, which we showed on the previous slide. That market price is 127,006. The next point has to do with the minimum value of a convertible bond. Now, listen to this carefully. The minimum value of a convertible bond is equal to the greater of these two numbers. The two numbers are the conversion value. So on 4th April, the conversion value is 103833 and the value of the underlying option-free bond. So if we assume that the conversion option is not there, we can look at the future cash flows and discount at the appropriate interest rates. We've done this enough times before, and let's say that for the interest rates that are relevant here and the cash flows, that minimum value is 107524. What this is saying is we find the maximum of these two numbers, which is 107524. This represents the minimum value or the floor of the convertible bond. And we can try and very quickly understand why. If the straight bond has this price and the bondholder has a conversion option, the value of the convertible bond should be at least this much. Also keep in mind that this is not a fixed flow. In a sense, it's a moving flow, because if interest rates change or the credit quality changes, then obviously the discount rate changes and the value of the floor will change. Next, we need to understand the concept of market conversion premium and market conversion price. Market conversion price is the convertible bond price, that's the current price of the convertible bond, divided by the conversion ratio. In our example, the convertible bond price is 127,006, that's the market price, divided by the conversion ratio, which is 16666.67. So the market conversion price is 7.62. This means that if we convert the bond, effectively this is how much we are paying for each share. The market conversion premium per share then is the market conversion price of 7.62 minus the actual underlying share price, which in our scenario is 6.23. So the market conversion premium would be 7.62 minus 6.23, which is 1.39. Based on these three numbers, we can also come up with the market conversion premium ratio. That is simply the premium of 1.39 divided by 6.23, which is 22.32%. Now let's say that a particular investor buys the convertible bond with the ultimate intention of converting to equity. So you might wonder why an investor would pay roughly 22% more for the equity by going through this convertible bond route. The investor could directly buy each share for 6.23, but instead, if he were to go through this route, he is paying a higher price per share of 7.62. The reason is that by buying the convertible bond, the investor is lowering downside risk. Think about a situation where the equity price just crashes. If the equity price crashes, then the value of the convertible bond is still based on the value of the underlying option-free bond. So the investor will also keep getting the coupon rate associated with the bond. So in other words, the convertible bond gives downside protection. In a sense, this is like a call option where an investor pays a certain call premium and then is protected against downside risk. So we'll see later that a convertible bond can be modeled in terms of an underlying bond and a call option. I just mentioned downside risk, and one measure of downside risk is the premium over straight value. We said that the straight value of this bond is 107524. This is the value assuming that there is no conversion option, but the market price of the convertible bond is 127006. So if we are saying that this straight bond price represents a flow, then this amount in percentage terms, if the bond were to fall from 127 down, that's roughly 18%. So this is an approximate measure of downside risk. But it's not a perfect measure because this is not a hard floor. This floor can actually go down. If the credit quality of the bond deteriorates, for example, then this floor will go further down. But it is still a rough first measure of downside risk. Now let's get a little deeper into the valuation of a convertible bond, and I've already alluded to this. The value of a convertible bond can be thought of as the value of a straight bond plus a value of the call option on the issuer's stock. With a call option, the investor pays a certain amount of money or a certain premium and is then protected against downside risk. So if we go back to the profit diagram for a call option at different stock prices, if the stock price falls, then all that the investor loses is that premium. But after that, if the stock price goes up, then the upside potential is unlimited. In a sense, with a convertible bond, the investor can keep getting the benefit of holding on to a straight bond and also has a call option on the underlying stock. So remember this relationship. What if our convertible bond is also callable? And this is the example, the waste management example that we looked at, that was both callable and convertible. So the value of that bond is the value of the underlying straight bond plus the value of the call option. So that's this part. And then we subtract the value of the embedded call option because investors do not like embedded call options. What if the bond is both callable and puttable? Then we simply add the value of the put option. We will now look at the risk return characteristics of a convertible bond. And here, let's just quickly remember the key points related to a convertible bond. A convertible bond gives the holder of this bond the right to convert the bond into equity at some predetermined conversion price. So in essence, a convertible bond is like holding an option-free bond and a call option on the underlying stock. And this call option becomes valuable as the underlying stock price increases. And we can think of that conversion price as the strike price for the call option. So now this picture that has been taken from the curriculum gives us a sense for the risk return characteristics of a convertible bond, and we'll see how the risk return characteristics depend on the value of the underlying stock. So that's the stock on which we have this call option, which is part of the convertible bond. Here on the x-axis, we have equity value. So here the equity value is low. Then we have this region over here where we have the conversion price. So let's say the conversion price is 50. And then we have this region where the equity price is much greater than the conversion price. If the underlying share price is much lower than the conversion price, so let's say we are in this region, say the equity price is 35, which is much lower than the conversion price. At this point, the option to convert into shares is effectively out of the money. And therefore, the convertible bond essentially behaves like a regular bond. In other words, the price of the bond will be sensitive to interest rates. The fact that there is a conversion option really doesn't help much because the call option is so far out of the money. So at this stage, we say that the convertible is actually a busted convertible. Then the other extreme is where the equity price is much higher than the conversion price. So let's say the equity price is now 60, which is much more than the convertible option. Now the holder of this convertible bond has the right to convert the bond into shares, and that right is at the strike price of 50, which means that this option is well in the money, deep in the money. So here the value of the convertible bond will closely track equity. We can therefore say that in this situation where the equity price is much greater than the conversion price, the risk return characteristics of a convertible bond are very similar to equity. So the convertible bond behaves like the underlying stock, and the price follows the price of the underlying stock, as we can see with this dashed line that is following the price of the underlying stock. And again, if we have a busted convertible, then the price of the convertible bond follows the price of the option-free bond. Now, what about this middle region where the stock price is around the convertible price? So in between these two extremes, and the two extremes are the ones I've just talked about, the convertible bond trades like a mixed instrument. The call option component increases in value as the underlying share price approaches the conversion price. So at this stage, the call option value increases because the stock price is approaching the conversion price. During such times, the return on the convertible bond increases significantly, but at a slower rate than the increase in the underlying share price. So here notice that the price of the convertible bond is increasing substantially compared to this region, but this increase is still lower than the increase in the underlying stock price. This is because the conversion price has not been reached yet. So it is likely that the call option will become in the money and become useful, and that likelihood is what is causing the value of the convertible bond to go up. But if the stock price does increase substantially, then, as I said before, the convertible bond starts behaving like equity. So to summarize, when the equity price is well below conversion price, a convertible bond behaves like an option-free bond, and it's called a busted convertible because the convertible bit of this bond isn't really helping. When the equity price is much higher than the conversion price, then the convertible bond behaves like equity. So the risk return characteristics are like equity. And in between, the convertible bond behaves like a mixed instrument. I now want you to work through example 9. Carefully read through this, and you need to have this information handy as you work through the next few questions. So what is the conversion price? The conversion price is equal to the par value of the convertible bond divided by the conversion ratio. So the par value is 1000. The conversion ratio given to us is 23.26. So the correct answer is 43. Next, try this. What is the conversion value on 16th September? The conversion value is equal to the underlying share price on that date multiplied by the conversion ratio. So this is the conversion ratio, 23.26 multiplied by the share price of 52 should give us this answer. Next, market conversion premium per share. This is equal to the convertible bond price, which is 1230, and that's given, divided by the conversion ratio, which is 23.26, minus the underlying share price, which is 52. So the answer is 0.88. Risk return characteristics of the bond on 16th September. Now here we need to look at the stock price relative to the conversion price. The market price on that date is 52. The conversion price is 43. So the stock price is substantially higher than the conversion price. If that is the case, then the convertible bond will be behaving a lot like the common stock. So that's why the best answer is B. Now we are told that the economic conditions are good. So when economic conditions are good and the credit spreads come down, then the bond values go up. But in our case, the convertible bond is acting a lot like equity, and it doesn't really matter what is happening to the bond price. You can also think of it this way. The value of the straight bond represents a flow, but given the share price right now, the value of the convertible bond is substantially higher than the floor. So even if the floor moves up a little bit, that won't really impact the convertible bond. So the best answer here is B. Now try this. The market price of 1050 is low compared to the minimum value. The minimum value is based on the conversion value. Given the current share price, what an investor can do is buy the bond for 1050 and then convert the bond into shares. If the bond is converted into shares and the shares are sold, then the amount pocketed is 1209, which is higher than the amount paid for the convertible bond. So the best strategy is buy the convertible bond, exercise the conversion option, and then sell the shares. So B is correct. Try this. Now notice that the market price is much lower than the conversion price. And if you remember our discussion earlier, when the market price is much lower than the conversion price, then the convertible security will behave like a bond. And just for completeness, if the market price is much higher, as it was in an earlier scenario, then the convertible bond behaves like a common stock. And if the market price of the stock is somewhere in between, around the conversion value, then the convertible bond behaves like a hybrid instrument. Here though, since the price is much lower than 43, the instrument behaves like a bond. That brings us to the end of this reading. We have covered a fair amount of material. We understood the concept of embedded options. Then we learned how to value callable and puttable bonds. We then looked at the interest rate risk of bonds with embedded options. Here the key formula was that of effective duration. So you need to understand effective duration and you need to understand effective convexity. Then we talked about valuation and analytics of capped and floating rate bonds. In all the valuation, the process is backward induction. And finally, we talked about the valuation and analysis of convertible bonds. Here the key is to remember the terminology. That is it for this reading.